Is Micron technology like the ultimate undervalued AI powerhouse of our generation? Or is it just this dangerously well-disguised value trap waiting to snare retail traders?
I mean, that really is the defining question in the market right now.
Right, because if you look at the charts today, it's down from its absolute peak, and it's flashing some pretty glaring short-term sell signals.
Yeah, but then you have these major analysts out there literally screaming that it's a strong buy.
Exactly. So, which is it? Are we staring at the opportunity of the decade or, a cliff edge?
Well, especially when dealing with a company that serves as the absolute bedrock of the artificial intelligence supply chain.
Right.
The data we're looking at is just incredibly polarized. It's pulling institutional money and retail traders in two completely different directions.
And honestly, untangling that polarization is exactly why we're here. But before we get into the weeds, I do have to collect a quick toll.
Oh, here we go.
You know how it is. You need to like this video and subscribe to our YouTube channel. And it is compulsory that you leave your comments and feedback below.
Yeah, we genuinely need to know what you think about this setup.
Absolutely. So, our mission for today's deep dive is clear. We are tearing apart the financial data, the technical charts, and the underlying market sentiment surrounding Micron technology, ticker symbol MU.
And that is as of today, Tuesday, April 14th, 2026.
Yes. But let's establish the ground rules right up front before we go any further.
Good call. Just to be totally clear, this is a natural debate, exploring the data for educational purposes only.
Right. Absolutely no financial advice is being given here.
Exactly. We're just mapping out the mechanics of the market.
Okay, let's unpack this. Because, we really have to start with the pure, unadulterated numbers.
Yeah, you have to look at the baseline reality of the company before you even touch the psychology driving the order flow.
Right. So where does the stock actually sit today, and what are the fundamentals supporting it?
So right now, Micron is trading at $426.56. It's up slightly today, about 1.42%. But the broader context shows the stock sitting in this neutral consolidation phase.
Right, because back in March, it hit an all-time high, didn't it?
Yeah, it hit $471.34.
Wow.
So we're down roughly 7.6% from that peak, though it did recently bounce off support around the 408 mark.
See, if you're holding this in your portfolio, that 7.6% drop from the top, that probably stings a bit.
Oh, for sure.
But zooming out, the context is just staggering. Do you know what the 52-week low for this stock was?
It was incredibly low.
It was $65.65.
Yeah, that is wild.
Going from roughly $65 to over $470 in the span of a single year, that is monumental whiplash.
It really is. But the thing is, when you look at the financials, the underlying mechanics actually seem to justify that run.
Really?
Yeah. Look at their Q2 fiscal 2026 income statement. They brought in $23.86 billion in revenue.
Wait, almost $24 billion?
Yes. That is a 196% year-over-year increase.
That's insane.
Net income is sitting at $13.79 billion, with a diluted EPS of $12.20.
Okay, I'm trying to visualize the mechanics of a 196% growth rate at that sheer scale.
Right.
It's one thing for a local neighborhood coffee shop to suddenly become a global franchise overnight,
Sure.
But doing it at a multi-billion-dollar run rate without taking on a dime of bad debt.
Well, and their leverage profile is arguably even more impressive than that top-line growth.
How so?
They're sitting on this fortress balance sheet with $16.7 billion in cash.
Wow.
Yeah, and their debt-to-equity ratio is microscopic. It's at 0.13.
So they're basically funding this massive expansion without being choked by debt servicing at all.
Exactly, and they generated a record $6.9 billion in free cash flow just in Q2.
Okay, so they organically exploded off the back of this AI boom. Specifically the high bandwidth memory bottleneck, right?
Yeah, the HBM constraint.
But to me, this sets up a massive contradiction.
What do you mean?
If the financials are this flawless, why is the stock drifting downward from its peak?
Right.
If the cash flow is a record, why are we stuck in this neutral consolidation phase instead of rocketing past $500?
Well, the friction comes from institutional timelines versus the underlying accounting.
Okay.
The market doesn't trade on Q2's past performance, It trades on Q4's probability.
Ah, right. It's all forward-looking.
Exactly. So to figure out why the stock is lagging its own flawless balance sheet, we really have to follow the money flow.
We need to see what the smart money's doing.
Yeah, look at what the institutions and insiders are structurally doing to position themselves.
Which brings us to a massive contradiction in the order flow. I mean, if you look at the options chain, it leans heavily bullish.
Very bullish.
The put-call ratio is 0.56, meaning there's significant volume betting on the upside.
Right, but then look at the short interest.
Exactly. The short interest is remarkably high. As of April 7th, almost 22% of the float is sold short.
That is a huge red flag for a lot of people.
I mean, nearly 22% short interest on a company with $16 billion in cash and 200% revenue growth.
Yeah.
That implies massive institutional hedging or prop desks making really concentrated bets against this specific valuation.
It really points to a sophisticated pairs trading environment.
Pairs trading, break that down.
So many funds will take a massive long position in a processor designer, right, like Nvidia or AMD,
Okay.
and then they'll short the memory supplier, which in this case is Micron, as a hedge against cyclical downturns in the broader semiconductor space.
Oh, okay. So it's a structural hedge, but the narrative gets even more fragmented when you look at insider activity.
Oh, the insider trades are fascinating right now.
Yeah, because we have director Tae-in Liu buying roughly $7.8 million worth of shares back in January.
Which signals a lot of confidence.
Right. But conversely, you've got EVP April Arnzen selling roughly $13.9 million worth of stock on April 1st.
And she wasn't the only one.
No, EVP Sumit Sadana unloaded about $10.7 million in February.
Yeah.
I want to pause on those executive sales, though, because retail traders often just panic when they see eight-figure insider selling.
They absolutely do.
But, I mean, is a $13.9 million stock dump from an EVP actually an immediate red flag?
Not necessarily.
Right. Because if you've been working at a company and your compensation package is tied up in stock that just went from $65 to $470 in a single year.
You can take some profits.
Exactly. Cashing in at a 52-week high to buy a yacht or just diversify your portfolio is human nature. Does an executive taking profits inherently signal a structural top?
Well, no, it doesn't inherently signal a top. An executive diversifying is standard practice. Right. However, when you combine nearly $25 million in rapid executive selling with a 21.9% short interest from institutional desks,
It starts to look a little coordinated.
it paints a picture of collective risk mitigation.
Okay, that makes sense.
The people managing the actual fabs and the quants running the risk models are both deciding that holding pure unhedged exposure at 470 is just too volatile.
Wow. We also have to factor in the macro signals coming from Washington.
Oh, the congressional trades?
Yeah, congressional trades are a data point a lot of swing traders watch for sentiment.
For sure.
So in Q1 of 2026, we saw buys from U.S. Representative Tony Weed somewhere in the 250K to 500K range.
Okay.
And Senator John Fetterman in the 1K to 15K range. And to be totally clear, we're looking at this strictly as data on the ledger.
We don't take political sides here.
Never. We're impartially reporting the data. But it shows that actors with access to high-level economic briefings are also taking long positions in the domestic semiconductor supply chain.
And that tug of war. I mean, you have insiders selling, politicians buying, options traders screaming call, and hedge funds screaming short.
It's pure chaos.
It leaves a very specific fingerprint on the charts. The technicals right now are literally a visual representation of a market that can't agree on a fundamental valuation.
So let's look under the hood at those charts. Where are the actual battle lines drawn between the buyers and the sellers right now?
The current support zones are actually incredibly well defined. We're looking at a moving average cluster providing a solid floor between $403 and $408.
Okay, so that's the floor.
Right. If the algorithmic sellers break that, the next safety net is way down at 334.
Oh.
Yeah, which lines up with the 0.5 Fibonacci retracement level from the recent macro run.
And what about the upside?
On the upside, resistance is parked right at the recent pivot of 444, and then you have that all-time high of 471.
See, the indicator war here is what really stands out to me.
Yeah, it's very conflicted.
Because if you're a trend follower looking at the moving averages, they are flashing a strong buy.
Absolutely.
Trading at 426 puts the price comfortably above the 50-day SMA of 402 and the 200-day of 398.
The long-term momentum looks incredibly healthy.
But
What's fascinating here is how their short-term oscillators completely reject that long-term health.
right.
The MACD, which measures the relationship between those moving averages, is actually flashing a short-term sell signal.
Really?
Yeah, it's dipping to negative 1.10 on the daily time frame.
Wow.
And the RSI is sitting at 57.37, just hovering in a sort of neutral no man's land.
So the charts perfectly capture a stock that is just trapped.
Totally tracked.
The moving averages are buoyed by the 196% historical growth, while the MACD is buckling under the weight of the 22% short interest.
Exactly. And the reason the charts are having an identity crisis is that the fundamental valuation models are violently contradicting each other.
I mean, the math used to calculate what Micron is actually worth is just totally disjointed.
It is, which brings us to the absolute core debate of this deep dive.
Is Micron an undervalued gem, or is it a meticulously disguised value trap?
Right. Let's start with the bull camp.
Okay.
Why are respected analysts calling this stock cheap?
Well, the primary argument for Micron being undervalued relies really heavily on relative multiples, specifically the forward PE.
Yeah, the forward price to earnings ratio.
Right. Barron's recently highlighted Micron as potentially the cheapest stock in the S&P 500.
Which sounds crazy after it ran up so much.
It does, but depending on which analyst's earnings estimates you use for the back half of 2026, Micron is trading at a wildly low 3.9 to 12.5 times forward earnings.
That is low.
I mean, when the broader tech sector, and specifically AI-adjacent hardware companies, are trading at 40, 50, or even 70 times forward earnings.
A multiple of 4 makes Micron look like an absolute steal.
But the bears are utilizing a completely different set of math, right?
Totally different.
They aren't looking at relative multiples. They're looking at the raw mechanics of cash extraction.
Yeah, they're using discounted cash flow models, or DCF. And DCF models are absolutely brutal on Micron right now.
Why is that?
A DCF model doesn't care that the stock has a low PE compared to Nvidia. It strictly projects the free cash flow the company will generate over its lifetime and then discounts that back to today's value.
Okay.
And when quants run those models on Micron, they suggest an intrinsic value of only $298 per share.
Wait, really?
Yeah.
Trading at 426, while a fundamental cash flow model says it's worth 272. That means it might actually be trading at a 20 to 40% premium to its long-term cash generation.
Exactly.
That is a devastating discrepancy.
And that discrepancy is the exact mechanism of a retail trap.
How does that catch the retail guys?
Well, everyday traders use basic screeners, right? They filter for the word AI, they filter for triple-digit revenue growth, and they filter for a low PE ratio.
Ah, I see.
Micron pops up looking like a golden ticket. They hit buy, completely ignoring the structural reasons why the market is pricing it at a multiple of 4 in the first place.
See, here's where it gets really interesting. It's exactly like buying a heavily discounted luxury sports car.
Oh, that's a perfect analogy.
You walk onto the used lot, and the sticker price looks unbelievably cheap for a V12 engine. You think you're getting away with a heist.
But you're not.
No, because what you aren't factoring in are the hidden structural maintenance costs.
Right.
The specialized oil changes, the brakes, the transmission that routinely grenades itself at 50,000 miles. The upfront multiple is cheap, but the underlying mechanics of keeping the machine running might bankrupt you.
Exactly. The market isn't inefficient enough to leave a tech stock at a 4 PE by accident.
It's pricing in risk.
Right. It's pricing in the historical violence of the memory cycle, which means we need to clearly weigh the specific catalysts that validate the bull case versus the catalysts that trigger that $272 bear case.
Okay, let's lay out that bullish recovery scenario first. Because some analysts like Cantor Fitzgerald and Arete, they have high-end targets pushing into the $700 to $852 range.
Which is massive upside.
Yeah, so for Micron to shatter that 471 resistance and march toward 700, what fundamentally has to happen?
The AI demand bottleneck has to remain structural and persistent.
Okay.
Micron is the only major US-based manufacturer of DRAM memory. Right now, there is a physical supply constraint for high bandwidth memory, which is the oxygen for AI processors.
Right, NVIDIA needs it to make their chips work.
Exactly. And because of this scarcity, Micron wields extreme pricing power. Furthermore, they are locked in and committed to producing HBM4 for NVIDIA's upcoming Vera Rubin platform.
Oh.
Yeah, and management's Q3 guidance points to a massive 33.5 to 33.8 billion in revenue.
That's a huge jump.
It is. If they execute on that and the HBM constraint lasts through the end of 2026, Those $700 price targets shift from optimistic to highly probable.
So the bull thesis relies entirely on the hardware arms race continuing at its current brute force pace.
Pretty much.
You need memory, there isn't enough memory, and Micron basically controls the faucet.
That's the bull case in a nutshell.
But let's flip it. What is the bearish case? What drags this thing back down into the 200s?
Well, the bearish continuation lower is driven by three compounding risks.
Okay, get me.
First, the geopolitical exposure is undeniable. With massive portions of the global semiconductor supply chain tethered to Taiwan and China, any kinetic escalation or severe blockade disrupts the entire hardware ecosystem.
Right, that's a macro risk for the whole sector. What's the second?
Second is the brutal historical cyclicality of memory stocks.
Oh, yeah.
The mechanism is almost clockwork. Memory companies see record prices, they overbuild foundries to capture the demand, they accidentally flood the market with chips, prices crash, and their earnings evaporate overnight.
It's the classic agricultural boom and bust cycle. Like farmers see record prices for corn, so every farmer goes out, buys new tractors, and plants wall-to-wall corn.
Yep.
By harvest time, there's so much supply that the price of corn plummets to zero, but they still have the massive debt payments on the new tractors.
That is exactly what happens. And for Micron, those tractors are incredibly expensive. Which brings us to the third massive risk.
Which is?
To compete in this current AI memory race against SK Hynix and Samsung, Micron has aggressively raised its fiscal 2026 capital expenditures to a projected $25 billion plus.
$25 billion?
Yes. That capex is pure cash walking out the door just to upgrade facilities and buy lithography machines. Even if they hit $33 billion in revenue, spending $25 billion just to keep the lights on. And the foundries, competitive, acts as a massive anchor on the free cash flow.
And that's what those DCF models are picking up on.
Exactly.
And hanging over all of this is the wild card risk, the systemic threat that institutional models are really struggling to price in right now.
You're talking about the TurboQuant algorithm risk.
I am. Based on the research in our stack, we're seeing massive developments in algorithmic efficiency.
Yeah, it's wild stuff.
Software engineers are building these advanced quantization models, dubbed TurboQuant, that basically compress AI processing. It allows models to run on lower bit precision without losing reasoning capabilities.
That's fascinating.
So what does this all mean? Like, does an algorithmic leap like TurboQuant fundamentally break the structural bottleneck that's keeping Micron's margins so high?
It acts as the ultimate industry disruptor. Because think about it, for the last couple of years, the AI narrative has been purely about hardware brute force, just throwing more GPUs and dense HBM memory at every single problem. But if software optimization like TurboQuant becomes the standard, it violently alters the compute-to-memory ratio.
Oh, I see.
Suddenly, you might achieve the exact same AI inference power using 30 or 40% less physical memory.
Which is huge.
Yeah. If the software solves the hardware problem, the structural supply constraint that Micron is profiting from just vanishes.
And then what happens?
Prices normalize, margins collapse, and that $25 billion capex bill becomes a devastating liability.
It's a literal race between the engineers building the physical chips and the coders trying to render those chips obsolete.
It really is.
So let's synthesize all these timelines as we bring this home, because how you approach this data depends entirely on your specific time horizon as an investor, right?
Absolutely. So in the short term, over the next few weeks, you should expect volatile consolidation. The charts show an imminent battle at that $444 resistance level. And that's going to be exacerbated by the upcoming April 15th dividend payment, where you'll see a lot of institutional rebalancing.
And stepping out to the medium term.
The medium-term narrative hinges entirely on June 24th, 2026.
Which is?
That is their next earnings print. Wall Street is modeling for that $33.5 billion revenue target. With a PE multiple this low, the market is basically daring them to fail.
So if they miss?
If they miss that guidance by even a fraction, the punishment will be incredibly swift.
Wow. But what about the long term?
Well, looking long term, through the rest of 2026, Micron's high bandwidth memory capacity is essentially fully allocated and sold out. The revenue for the current production cycle is practically locked in at this point.
Oh, okay, so the cash is basically guaranteed for the year.
Pretty much. If we connect this to the bigger picture, Micron is a fundamentally phenomenal company currently operating inside a macro environment of peak uncertainty.
That's a great way to put it.
The tension isn't about whether they are generating record cash today. It's about whether the market algorithms have already fully priced in the peak of this specific hardware cycle.
Which brings me to this final thought for you to chew on as we wrap up.
Let's hear it.
We know Micron is currently pouring over $25 billion into capex. They have to play this hand to race against SK Hynix and Samsung, basically building the foundational infrastructure for this AI boom.
Right.
But if the AI landscape shifts beneath their feet, I mean, if quantization algorithms like TurboQuant become the new norm and the industry suddenly needs drastically less physical memory to run the world's models,
Yeah.
will Micron's $25 billion gamble secure its crown as the undeniable AI king? Or are they quietly building the world's most expensive factories for yesterday's technology?
That is the multi-billion-dollar question.
It's a question you have to seriously consider before staring at that low PE ratio and jumping in blind. We want to thank you for diving deep into the data, the charts, and the mechanics of the market with us today. Keep questioning the consensus, and we will see you on the next deep dive.